Welcome to the Deep Dive. Today, we're digging into a fascinating piece of corporate history. We've got the 1989 shareholders letter from Fairfax Financial. And let me tell you, it's quite something in terms of, well, honesty.
It really is. They don't kick things off with boasting right away. They admit it. They thought 89 would be tough, but then they say, straight up, it was actually much worse.
Yeah, that's what grabs you, isn't it?
Yeah.
So our mission here for you, the listener, is to kind of pull apart this contradiction. How does much worse somehow end up with book value climbing 22% to $12.41 per share? We really want to extract those lessons on, brutal honesty, resilience, and how you juggle operational disasters with, well, really smart investing.
That's the heart of it, that paradox. Because, yeah, despite all the internal trouble, net earnings overall, they went up 16% to $16.7 million. But, and this is key, those headline numbers, they were hiding some pretty serious problems under the hood. It wasn't the main business driving it. So let's figure out how they manage that financial juggling act.
Okay, yeah, let's break down that core conflict using their own table. The operating earnings before realized gains, that's the pure measure of the actual insurance business, right?
Yeah.
That number took a nosedive, fell 43%, just plummeted from, $15.7 million down to only $8.9 million.
A huge drop, 43%. That tells you the core operation was really struggling. And adding insult to injury, interest expense shot up too, 136% increase, added about $3 million in costs. But then here's the other side of the coin, the investments.
Right.
Realized gains on their investments basically doubled, up 99%, from $7.8 million to $15.5 million.
Wow. So it really does feel like they were, using the investment gains to patch the holes in the operating side. But hang on, relying on realized gains, isn't that kind of risky long term? I mean, it's not the core business. Is that sustainable?
Well, that's always the big question with this kind of structure, isn't it? It's definitely a risk. But for this year, 1989, those gains, about 12% of their whole portfolio, by the way, they were absolutely essential. They covered those operating losses, covered the higher interest costs. And something else helped too. Their tax bill dropped significantly, down 77%, because some of that investment income had lower tax rates or was exempt.
Okay, so the 16% rise in net earnings, mostly an investment story and a tax story, not an underwriting one. But still, even with that core business struggling, they pulled off a 20.3% return on common equity, which, as a performance check, is pretty impressive. It smashed the TSE 300, that's the main Canadian index, which only did 11% that year. So the assets really did cover for the engine trouble.
Yeah, the strategic assets definitely plugged the gap.
So where did that 43% operational drop actually come from? The letter doesn't mince words here. They start with this quote about how since 85, they'd rather shrink than write bad business. Yeah. But then for 89, they just admit, we failed miserably in Markel.
Yeah, that failure was very specific, but boy, was it big. Markel Insurance Company, that was the anchor dragging everything down. A huge underwriting loss is how they put it.
And the number they quote for Markel's combined ratio,
yeah,
it's almost legendary, right? 133.6%. Just miles away from their target of 100%, which is break even.
Right. And let's just clarify that for everyone listening. A combined ratio over 100 means you're losing money on the insurance you're writing. 133.6% means for every dollar of premium they took in, they were paying out over $1.33 in claims and expenses, just hemorrhaging cash. The total underwriting loss hit $14 million, and their internal plan, they only expected a $1 million loss. That kind of transparency, admitting a $13 million miss, that takes guts.
It really does. And they were brutally honest about why it happened, too. They called it unprofitable diversification like chasing business just because it looked greener elsewhere, specifically getting into things like insuring taxis, the surety business. And they admitted they break their own rules by taking on trucking risks at prices that just weren't profitable.
And this is where you see the classic challenge of a decentralized model. Fairfax believes strongly in letting presidents run their own show. But the letter is candid about the downside. Stuff can go wrong, badly wrong, before the head office even knows the full extent of it.
Yeah, and what went wrong in Markel's surety business wasn't just a mistake. It sounds like pure chaos. They said it was run in a very loose manner. They found performance bonds issued way over their reinsurance limits. And even worse, undeclared claims on financial guarantee bonds, where they had zero reinsurance cover. None.
Can you imagine Just uncovered exposure.
The combined ratio, just for that surety part after they actually accounted for everything properly,
An unbelievable.
343%.
Yeah, 343%. Just
Yeah.
let that sink in. That's not just bad underwriting. That's a catastrophic failure of internal controls.
So after that kind of disaster, a 343 ratio, why wouldn't you just slam on the brakes, centralize everything, take away the president's autonomy? Clearly the decentralized thing failed them spectacularly there.
Well, that's the philosophical tension, isn't it? They genuinely believed centralization kills that entrepreneurial spirit, that long-term value creation. So the fix was, well, it was still within their decentralized philosophy, but with a necessary layer added. They reorganized early in '89. They put David Rooney and Rick Salzberg at the Fairfax level, responsible for overseeing the key companies Markel, Shand, Morden, and Hellwig. They didn't strip the presidents of power, but they introduced mandatory annual business plans, performance reviews, basically adding oversight to catch this stuff earlier, more rigor, but keeping the core decentralization.
Right, trying to get the best of both worlds. So while Markle was the big dumpster fire, the rest of the group wasn't exactly static either. Lots of changes happening, like Shan, Morahan. They were still profitable, managed a 13% return on equity, which is decent, but their combined ratio crept up too to 118.6%, mainly because of costs from running off old business lines.
True, but Shand also showed the flip side, the value of being conservative. They managed their reserves really well. Remember that contingent note from when they bought Shand? It started at US $47 million. By '89, they'd knocked it down to US $23.5 million. That shows discipline in managing liabilities, reducing future risks.
Okay, good point. And then there was Morden and Hellwig, the claim side. That saw huge growth. Canadian revenue jumped from roughly $31 million to almost $47 million in just 3 years, mostly through big acquisitions, right? Lindsay Newsom in the U.S., Hampkin Holdings in the U.K.
Yeah, really rapid expansion. But it's a perfect example of how growth isn't always smooth sailing. While Canada was doing well, profitability in the US and UK took a hit. Why? Because merging those big operations, integrating them, it just took a ton of effort and cost a lot up front. It ate into the profits. So it shows even savvy acquirers find integration tough. It wasn't just Markel facing operational headwinds.
Makes sense. And then the new kid on the block, Walwyn Inc., the investment bank they bought. That lost $5.3 million in its first year, which they actually said they expected. The letter was pretty frank that individual investors just hadn't come back to the stock market after the '87 crash. So tough environment, even though they were bringing in good people and improving research.
Exactly. That $5.3 million was basically the cost of entry the investment needed to build that platform for the next cycle. And while that was happening, look at Sphere Re, another strategic move. They realized they didn't really have a unique edge in the reinsurance market, which was super competitive. So what did they do? Sold the reinsurance book to Scandia Re for $5.75 million. And they thought they'd probably get even more than they initially estimated from that deal.
Smart. Cut your losses. Or rather, exit a tough spot. And they didn't just sit on the cash, right? They took the remaining company shell, renamed it Checkers, got a new license, and focused it on really specific niches, like selling personal insurance through Eaton's department stores.
Yeah.
Very target.
That's agile capital allocation right there. Get out of what's not working, double down where you see an advantage.
Definitely. And speaking of doubling down, even with all the Markle drama, they made 2 big acquisitions late in the year. Shows they were still looking forward.
Yep, very forward-looking. First was Federated Insurance Holdings, bought for about $28 million. And interestingly, mostly financed with contingent notes.
Right. And just remind us, a contingent note means the payment depends on future performance, basically.
Yeah.
Defers the cash outlay.
Exactly. Limits the upfront cash needed, shifts some of the risk onto the seller based on how well the business does later. Smart structuring. And the second big move was taking a major passive stake in FCA International, which was one of the biggest collection agencies in North America at the time. They mentioned planning to bring in a financial partner there too. Shows an appetite for different kinds of service businesses, maybe distressed situations.
Okay, so let's shift to the philosophy underpinning all this. Operations were messy, but the balance sheet actually got stronger. They cut total debt by over $7 million down to $13.4 million, swapped short-term debt for longer-term commitments. That's pretty disciplined financial management when your main business line is bleeding cash.
Absolutely. And that strong financial footing supported what was, frankly, an outstanding long-term investment record. Since they started in '85, their Canadian stocks compounded at 20.7% a year. The TSE 300 benchmark, only 11.7%. And the U.S. portfolio, even better, 24.6% annually versus 17.7% for the S&P 500. Consistent outperformance.
And they even told us which specific investments bailed out in 1989. The letter names names: realized gains from Royal Bank, $2.7 million, Princeton Mining, $2.1 million, Progressive Corp, $1.7 million, Bank of Commerce, $1.6 million, Lowe's Corp, $1.5 million.
And look at those names. These weren't wild speculations. These were solid, often value-oriented, maybe contrarian bets that they'd held patiently. Royal Bank, Lowe's. It proves they were actually doing what their philosophy said. The investment arm was executing separate from the operational fires they were fighting.
And that investment thinking wasn't just about what they owned, but also recognizing craziness elsewhere. The letter voices real skepticism about Japan's market bubble, pointing out Nippon Telephone trading at, 81 times earnings? Insane.
81 times.
And they mentioned Taiwan, too, how there were 250 brokerage firms, but only 172 listed companies. Just pure speculation.
That kind of clear-eyed view of market excess, that willingness to call it out, that's classic value investing, sticking to your principles.
Right. And it leads to their bigger point about market psychology. They described the 1980s beautifully, characterized it as low expectations versus excellent results. Everyone was worried about recession, debt, all that.
Constantly, yeah.
Yet the S&P 500 just kept compounding away at almost 18% a year.
It's a great mental model for you, the listener. When should you really worry? Not when the headlines are bad. Worry when everyone is wildly optimistic, when those how to get rich in the stock market books are flying off the shelves. That's the time for caution.
It really circles back to patience, doesn't it? They use that incredible Laidlaw example, how $3,000 invested back in 1969 turned into $2.6 million 20 years later,
Wow.
a 40% compound annual growth rate.
40% a year for 2 decades. It just shows the power of finding a great business and holding on, ignoring the noise.
Okay, let's wrap up this deep dive into Fairfax's very eventful 1989. Looking ahead to 1990, they were honest again, acknowledged the headwinds were still there. The insurance cycle was still tough. Markle needed fixing. Walwyn might still lose money. And who knew what the stock market would do?
Yeah, they flat out said, look, we hit 20% return on equity in 89, but don't necessarily expect that again in 90. But that's okay, because their goal wasn't just 1 year. It was, and still is, 20% plus returns over the long haul. And the track record backed it up. From 85 to 89, their average ROE was 24.6%. The TSE 300, only 11.4%. That's the compounding difference.
So what they really proved in 89 wasn't just financial juggling. It was navigating a really tough governance challenge. They faced up to the Markle failure incredibly fast, admitted it publicly. But then crucially, they didn't abandon their core belief in decentralized management, even though that structure kind of allowed the Markle mess in the first place. They doubled down on it, but with added checks.
And that leaves us with a really interesting thought for you, the listener, to chew on. They got through the crisis by adding oversight without full centralization. So how do you strike that balance? How do you give people freedom they need to be entrepreneurial, to drive growth, while still having the controls in place to stop things from going completely off the rails, like they almost did at Markle? That tightrope walk between freedom and control. That was the fundamental challenge Fairfax was grappling with as they headed into the 1990s.